Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So this video is going to be the next installment in our Guru Investor series that we've been doing on the channel for the past few weeks. Now, this is a series where I look at my favorite investors of all time, and basically for each of those people, I give you my top 3 lessons that I have learned from those investors. So if you're interested in checking out all of the videos in this series, I have put together a playlist, so feel free to go and check out that Guru Investor series. But for this video, we're talking about my guy up here, Charlie Munger, Warren Buffett's longtime partner at Berkshire Hathaway, and a phenomenal investor in his own right. Now, before we get into it, I thought it would be useful to go through and look at Charlie Munger's actual performance record, because I know a lot of times he just gets sort of lumped in as being Warren Buffett's partner, Warren Buffett's sort of sidekick, but he has a phenomenal investment track record in his own right. And I'm going to go through one of the appendices of the revised version of The Intelligent Investor by Ben Graham. And it's actually from a lecture that Warren Buffett did called The Super Investors of Graham and Doddsville. And it basically goes through all of the investors that sort of followed the principles of Ben Graham that he laid out in The Intelligent Investor and in his classes at Columbia, and the students that sort of went on to run their own investment partnership. So Charlie Munger did run his own investment partnership. I'll try and put up screenshots of his results here. But long story short, even after coming out of the massive stock market crash of the early 70s, he ended up with a 19.8% compounded return over the lifetime of running his fund. And I know that when he wound up his fund, he only held sort of a handful of stocks. I think it was roughly 3 stocks in that partnership. And they were still very cheap, very discounted. And he basically told his partners to continue holding on to those stocks, even though Charlie had gone and wound up the partnership. So I have a feeling that if you extended this track record out a couple of years, it would probably look even better. But nonetheless, close to a 20% compounded return is absolutely phenomenal. And if you can maintain that for any reasonable period of time, you get very rich very quickly. So that is Charlie Munger's performance track record. He's obviously gone on to Berkshire Hathaway after this. He's also made very successful investments in businesses like Costco, and he also has put money to work with Lee Lu, which has done very, very well also. So that's a bit of background on Charlie Munger, but for now, let's get into my top 3 lessons. Now, the first lesson I have from Charlie Munger is arguably his most famous, and certainly the one that was the most transformational for his partner, Warren Buffett. Now, this lesson goes something like this. It's much better to buy a great business at a fair price than a fair business at a great price. And essentially what this means is in the early days of Warren Buffett's career and Charlie Munger's career, they really went down this very Ben Graham track of buying heavily discounted businesses. In other words, they really didn't care that much about the qualitative aspects of the business, brands and things that would potentially give that business long-term competitive advantages. They were really just looking for companies that were statistically cheap. So perhaps businesses that were trading for less than the cash that they had in their bank account after you subtract out all the debt. Maybe it's a company that you could just liquidate, sell all the assets, and distribute that cash to the shareholders and make a profit on that. That's basically the approach that Buffett and Munger took in the early days. It was buying these cigar butt type businesses, as they put it, these little kind of worn out cigar butts that you see lying on the ground, but they still had a little bit of puff in them, and they were basically free. They were trading at such cheap prices. So that was sort of the original investment model. But one of the things that happened as Buffett and Munger and Berkshire Hathaway grew into a larger and larger size and continued to generate so much cash that they had to redeploy into new investments, is they really struggled to find these cigar butts. It didn't scale that well, and when they got to managing billions and billions of dollars, there wasn't a lot of these, weird little discounted businesses around, and they kind of had to switch their investment philosophy to businesses where they could still make good returns, but they could hold forever. They weren't looking to hold a business for a couple of years or liquidate a company or anything like that. They needed businesses that they could hold onto basically for a lifetime. And that's where this great business at a fair price analogy comes in. So you see this transformation from the Berkshire Hathaway investments going from terrible businesses but extremely cheap prices, making them still very good investments, to basically the opposite. So you have really high quality businesses, but you're still paying some attention to price. Now, you're probably not going to get these higher quality businesses at sub-liquidation values or at the value of cash that they have in that company, but you are still going to be able to get them at less than their intrinsic value every now and then when we have big fluctuations in the market or the market doesn't understand a particular business that well. And it's how we had Berkshire Hathaway get into investments like Coca-Cola, like See's Candy, and these businesses that they've been able to basically just sit on, hold forever, collect the dividends, and really just have to make that one decision to purchase the great company at a reasonable price rather than an extremely discounted price, and just let the compounding internally in the business do its thing. Now, the second lesson I have from Charlie Munger is that the money to be made in the stock market is not made from the buying or from the selling, it's made from the waiting. And basically what Charlie Munger is getting at here is that really good investment opportunities are extremely rare. And when they do come along, you have to be very patient, first of all, to wait for them and make sure that they are a perfect pitch that you can hit out of the park, essentially, when you make that particular investment, and you're not reaching for things outside of your circle of competence or that are maybe trading at too high a price. But when these things do come along, you have to get into them at scale. And an amazing example of this that Charlie Munger actually went through himself, and I'll try and leave a link down in the description to a video that someone just filmed on their phone of Charlie talking about this one time, was when Charlie Munger talked about an investment he made after seeing the company mentioned in Barron's. Now, Charlie Munger at that point had been reading Barron's for over 50 years, and in each edition of Barron's there are stock tips, and it worked out that, you know, if he got 2 stock tips every week over 50 years, it was thousands and thousands of stock tips over those 50 years of reading Barron's. And after those 50 years, he made one investment. He saw Barron's talking about this dinky little auto parts company called Tenneco. Charlie Munger ended up putting $10 million into Tenneco, as he describes, by taking very little risk and having this unique sort of risk reward profile where it was an extremely cheap stock and his downside was very, very limited, but there was a lot of upside potential. And basically what happened is over the following 2 years, he turned that $10 million into $80 million. He then gave that $80 million to Li Lu in Himalaya Capital, and Li Lu had at that time turned that cash into something like $400 or $500 million. So there was really one key decision that he made. He waited a long, long time to make that investment, and although he was already rich, what he's kind of getting at is that you don't need many of those decisions to do very, very well financially through your life. So that was my second lesson from Charlie Munger. The money is not made in the buying or selling, but in the waiting. Now, my third and final lesson from Charlie Munger is actually a slightly more recent one, and it's one that I already had sort of in my head, but it's been nice that Charlie Munger has actually gone out and just straight up said this, and I think it's made the idea much more mainstream. So basically the idea is that all intelligent investing is value investing. Now, often value investing gets thrown in this boat where you're often just looking at low PE companies or low price to book companies, or, you know, these cigar butt type businesses that we talked about earlier in this video. But really, value investing fundamentally is just buying something for below its intrinsic value, what it's basically worth. So, you know, whether you're looking at a company that has no cash flows and it just has a bunch of assets and you can buy it for less than the value of those assets, or whether this is a company that is going to grow and produce a lot of cash flows out into the future, and you can buy that business at less than the present value of their future cash flows. Both of those are examples of buying a business below its intrinsic value, and both of those are value investing. So the idea that value investing is different from growth investing, which is different from growth at a reasonable price or whatever it is ridiculous. Growth is a major component of valuing a business. If you have a company that you buy for 10 times earnings and the earnings go down to basically nothing over the next decade, that can be a very expensive purchase. And if you buy another company at 40 times earnings, but those earnings 10x over the next 10 years, that 40 times earnings can turn out to be actually a very cheap investment on the surface of things. Now, you have to be careful on how much growth you sort of assume over the next decade or however long you intend to hold the business when you're making these investments. But fundamentally, just looking at a simple metric like a PE or a price to book or anything like that, that is not value investing. That is some sort of quantitative metrics that give you a little bit of a hint about where a particular company might be. But really, value investing is about buying something below its intrinsic value, and growth and value are joined at the hip, as Charlie and Warren like to say. So all intelligent investing is value investing. You can buy Tesla, for example, and have it be a value investment if you truly believe that the price today more than justifies the cash flows that Tesla will produce out into the future. And that's really all there is to it. You have to buy a company below its intrinsic value. If you don't do that, or if the company doesn't perform quite as well as you might have hoped, and you don't have that margin of safety from buying below intrinsic value, your returns aren't going to be good. And that's just a fact of life, and that's the way that the world works. So that's my third and final lesson from Charlie Munger. All intelligent investing is value investing. So that's all from me today, and those are my top 3 tips from the absolute legend Charlie Munger. If you have anything you think I've missed from Charlie or any great lessons you've picked up from the guy, let me know down in the comments below, and let me know also which investors you would like to see next. I'm certainly open to suggestions, and I will be continuing to do this series on the channel because it has been pretty well received. So hope you enjoyed the video, but that's all from me today, and I hope you have a great day. Cheers.